Let's take a moment to think of Jim Simons or James Simons. He died today at the age of 86, and he was a mathematician that was beating Wall Street constantly. He made annual returns of more than 50% over decades. And he didn't do this based on guesstimates. He didn't do this based on fundamental analysis. He made this all based on mathematical models. He's a bit of a role model to me because it really shows that the market is a game of skill. And of course, the stock market is way more skilled than other markets. When you play in crypto, you don't have that tough competition. You don't play against the Jim Simonses of this world. But it clearly shows that economists with their efficient market hypothesis are not right. And it also shows that having a systematic approach, so not an approach based on gut feeling, but based on clear rules that get validated and maybe dismissed, can be a very long-term successful approach. Now let's have a look at a few clips of Jim Simons. Let's have a look at the wisdom that he left us with.
Okay, so that's at least given us a flavor of that amazing mind in there. Let's talk about Renaissance, because you took that amazing mind and, having been a co-cracker at the NSA, you started to become a co-cracker of the financial industry. I think you probably didn't buy efficient market theory, and somehow you found a way of creating these astonishing returns over 2 decades. I think the way it's been explained to me, what's remarkable about what you did was that it wasn't just the size of the returns, it was that you took them with surprisingly low volatility and risk compared with other hedge funds. So how on earth did you do this, Jim?
Well, I did it by assembling a wonderful group of people. When I started doing trading, I had gotten a little tired of mathematics. I was in my late 30s, I had a little money, I started trading, and it went very well. I made quite a lot of money with pure luck. I mean, I think it was pure luck. It certainly wasn't mathematical modeling. But in looking at the data, after a while, I realized, hey, looks like there's some structure here. And I hired a few mathematicians, and we started trying to make some models. Just the kind of thing we did back at IDA. You design an algorithm, you test it out on a computer, does it work, doesn't it work, and so on.
So can we take a look at this? Because I mean, here's a typical graph of some commodity or whatever. I look at that and I say that's just a random up and down walk, maybe a slight upward trend over that whole period of time. How on earth could you look at that and see something that wasn't just random?
It turns out in the old days, and this is kind of a graph from the old days, commodities or currencies had a tendency to trend. Not necessarily the very light trend you see here, but trending in periods. And if you decided, okay, I'm going to predict today by the average move in the past 20 days, there's 20 days, maybe that would be a good prediction and I'd make some money. And in fact, years ago, such a system would work. Not beautifully, but it would work. So you'd make money, you'd lose money, you'd make money, but this is a year's worth of days, and you'd make a little money during that period. But it's a very vestigial system.
So you would test a bunch of different sort of lengths of trends in time and see whether, for example, a 10-day trend or a 15-day trend was predictive of what happened next?
Sure. You would try all those things and see what worked best. But the trend following would have been great in the 60s, and it was sort of okay in the 70s. By the 80s, it wasn't such a
It didn't, because everyone could see
other people.
Now, this is already a first interesting insight, right? What this tells us is that even based on those mathematical models, they need to be updated. And it tells us that efficiency in markets develop over time. In other words, if you invested with those simple kinds of approaches in the 60s, you would have made money. Nowadays, you wouldn't. But again, that's relative to the market that you're investing in, right? Probably that kind of approach still works in crypto, for example, because in crypto, the competition is not the Jim Simons of this world. In crypto, you've got random degen gamblers on Binance.
So how did you stay ahead of the pack then?
Well, we stayed ahead of the pack by finding other approaches and shorter-term approaches to some extent. But the real thing was to gather a tremendous amount of data. And we had to get it by hand in the early days. We went down to the Federal Reserve and copied interest rate histories and stuff like that because it didn't exist on computers. We got a lot of data and very smart people. And that was the key. I didn't really know how to hire people to do fundamental trading. I had hired a few. Some made money, some didn't make money. I couldn't make a business out of that. But I did know how to hire scientists because I have some taste in that department. And so that's what we did. And gradually these models got better and better and better and better.
I mean, I think you're credited with doing something remarkable at Renaissance, which is building this culture of this group of people who weren't just hired guns who could be lured away by money. Their motivation was doing exciting mathematics and science.
Well, I hope that might be true, but some of it was money.
They made a lot of money.
I can't say that no one came because of the money. I think a lot of them came because of the money, but they also came because it would be fun.
What role did machine learning play in all this?
Well, in a certain sense, what we did was machine learning. You look at a lot of data and you try to simulate different predictive schemes until you get better and better at it. It doesn't necessarily feed back on itself the way we did things, but it worked. And still
so
does.
these different predictive schemes can be really quite wild, quite unexpected. I mean, you look at everything, right? You look at weather, length of dresses, political opinion.
Length of dresses we didn't try, but...
what sort of things?
Well, everything. I mean, everything is grist for the mill, except hem lengths.
So what this tells us that this is also a game of data gathering, right? A lot of people simply just look at price data. They look, say, at the Bitcoin price, and they look at, say, the halving, and they say, okay, I believe that the price might likely behave the same way as it did in prior halvings. But the nice thing about crypto is that we do have a lot of additional data that you don't have, say, in the traditional finance world, right? Jim Simons, for example, also used weather data, which could be an impact, right? Weather does have an impact on mood, and mood has an impact on trading decisions, and weather can also have a direct impact, of course, on businesses, right? If you run an ice cream shop, then of course, when it rains, you will make less revenue. But what this tells us is that data gathering and finding data that most people aren't consuming is super important. That's, for example, why we use all of that blockchain data, right? That's why we use Dune Analytics. That's why we build our own tools with Dune Analytics in Premium. We try to get an edge versus the others by using data that most people don't have access to, or that most people simply don't bother gathering.
I have to say. Weather, annual reports, monthly, quarterly reports, the historic data itself, volumes, you name it, whatever there is. We take in terabytes of data a day and store it away and massage it and get it ready for analysis. And you're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But
right.
Any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. So you can see an anomaly that's persisted for a sufficiently long time so that the probability of it being random is not high. But these things fade after a while. Anomalies can get washed out, so you have to keep on top of the business.
A lot of people look at the hedge fund industry now and are sort of shocked by it, by how much wealth is created there and how much talent is going into it. Do you have any worries about that industry and perhaps the financial industry in general, kind of being on a runaway train that's I don't know, helping increase inequality, or how would you champion what's happening?
Well, actually, I think in the last 3 or 4 years, hedge funds have not done especially well. We've done dandy, but the hedge fund industry as a whole has not done so wonderfully. The stock market has been on a roll going up, as everybody knows, and price-earnings ratios have grown. So an awful lot of the wealth that's been created in the last, let's say, 5 or 6 years has not been created by hedge funds.
Yeah, the discussion becomes a bit philosophical here, but what I think is a good takeaway is that the winner takes most. Profit is very much concentrated in just a few hands. That's within the regular economy, right? You buy the best phone, you don't just buy a random manufacturer's phone. It's also true for trading, right? If you have an approach that tended to work well in the past, and there is a good likelihood that it will continue in the future, at least for a while. And so if you're following this channel for a while, you know that I like these kind of approaches a lot. I like to backtest, for example, moving averages. The 120-day simple moving average for Bitcoin works the best. I also like to look at data that most people aren't considering. For example, the value days destroyed multiple in Bitcoin, showing what are the long-term holders in Bitcoin doing. That's how I timed the top and sold one day after the all-time high in Bitcoin, and I'm still quite a bit in cash. I'm not yet buying, and the reason is other kind of data most people aren't looking at, for example, the stablecoin market caps, etc. But more on this in other videos, not necessarily in this one. For this video, I simply just want to thank Jim Simons for being so transparent around an investment approach that's rather opaque to most others. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. There's also a free Telegram. Feel free to join us. Link is down below.